we'll get started on here. So what we're going to be spending some time on tonight is basically the part that fills in the second part of the intake form. So we kind of reviewed this in last week's session where how important it is to fill this out completely and accurately. And we're going to focus tonight on part two, marital status and household information. And we'll get to that right now. So oops, that's not what I want. Okay. All right, filing status and dependency. Okay, there are five filing statuses. You got to pick one. Single, head of household, married filing jointly. We do need to know if they were living together or apart at the end of the year. Generally, they are living together if they're filing jointly. Married filing separate, and a qualifying surviving spouse. Okay, and the importance of getting the filing status correct is pretty obvious. I mean, it determines the amount of the standard deduction as well as other aspects on the tax return. For year 2023, the standard deduction for single and married filing separate is $13,850. Married filing joint and qualifying surviving spouse is $27,700, and head of household is $20,800. So again, starting, and there is additional funds of $1,850 if you are over 65 and or blind. Again, if it's married filing joint and they're both above 65 and they're both blind, well, you can see where the math goes there. We'll be getting into more of the specifics about how the actual deduction impacts the tax return as we get further along in the training. Again, other impacts on the return of the return on the status is what the filing threshold is, the exclusion of certain tax credits and adjustments for married filing separate, and allowance for the full standard deduction for married filing separate. Okay, again, as I mentioned last week, 72% of our returns last year were single tax or were filing single. Again, if they are unmarried on the last day of the calendar year, they're single. And unmarried means they've never been married, they're divorced, they're legally separated with a court decree, or surviving spouse, but not a qualified surviving spouse filing status, which means there's no children involved. It's almost always number one and number two, or another situation, which we'll get into as far as whether or not they bother to go to a court proceeding. So in this situation, simple one here, Scott's divorce was finalized on December 30th of 2023, and he has no dependents. What would his filing status be for tax year 2023? Okay, the answer is single, because he was considered divorced on the last day of the calendar year. So again, what you are on December 31st drives what your filing status is. On the flip side, if Scott's divorce was not finalized until the 1st of January 2024, his status for 23 would be, again, he's still married as of the 31st of December. So again, it's either going to be filing jointly or filing separately. Again, that will depend on what his ex-spouse will decide. All right, head of household. This is another chunk of our cohort that we see. Again, these are single parent homes. Generally, almost exclusively, they're single mothers. Again, a taxpayer may file head of household if on the last day of the calendar year they are unmarried or considered unmarried, and we'll talk about that in a second, and they provide more than half the cost of maintaining the household for themselves and a qualifying person who must live in the same household. Again, they're not just sharing child support issues. Okay, they got to live in the household, and they must meet all three of the tests to qualify as head of household. So the marital status, the housing, and the qualifying person. And this part in the red here pretty much sums up most of our cohort that qualifies as head of household. they're not married, they're paying all the bills, and they're taking care of another person, whether that is a child of their own, a child of a descendant, or possibly an adult relative. When we see considered unmarried, we will frequently see people who indicate that they are married, but again, the spouse is nowhere to be found. Again, they haven't been together for years. He returned to another country, another state, who knows? But the reality is, they are legally considered married, but again, they're not living with another person that they're married to. They don't know where they are. For all intents and purposes, they really are divorced. It's just that it hasn't gone through in a legal proceeding. All right, head of household qualifications. Okay, a little bit more detail here. So on the last day of the year, a taxpayer is unmarried, legally separated under a separate maintenance decree, or divorce under a final decree on or before the 31st. So a married taxpayer can only claim head of household if they did not live with their spouse the last 6 months of the year, and they meet the other two criteria. Again, that kind of gets back to what I just said, that again, the last 6 months of the year, again, they may still be married, but they weren't living with anybody. So again, that takes that qualifies that part of the requirements. Housing, they pay the cost of keeping up a home for the year, and that includes expenses such as rent, fair market rental value of the home, repairs, utilities, groceries, again, all the usual things of housing costs, and the qualifying person. So that must have lived in the taxpayer's home for more than half the year, at least 183 days. A dependent parent does not have to reside with the taxpayer, and we'll get into that a little bit later. But what that means basically is if you pay more than half the expenses for your parent and they live in another town, another state, or believe it or not, Mexico or Canada, you can claim them as a qualifying person. So here's an example for head of household. Jeremy is divorced and paid for 100% of the cost of keeping up his home for the year. His son lives with him, and he is the primary caregiver for his son. What is the status? Again, head of household, because he meets all the necessary requirements. And that is generally about as black and white as it gets for most of our clients. Again, Jeremy on the other side, Jeremy is divorced and paid 100% of the cost for keeping up his home. His son lived with him for 3 months in the summer. What is his filing status? Again, in this case, it's going to be single because he did not have him in his home for more than half the year. Okay, married filing joint qualifications. Okay, if the two taxpayers are married, they can choose to file either joint return. And if one of the spouses dies during that tax year, the surviving spouse can still file a joint return for that year. Okay, that's that 1 year only. All right, someone whose spouse passes away after the end of the calendar year to file a joint return for the tax year will typically file married filing jointly. Again, they can only file it if they didn't marry for the rest before the end of that year. So if the spouse dies in January 2024, the taxpayer files in February 2024 for the tax year 2023 as married filing jointly, since the spouse was alive on the 31st of December. The following year, okay, the taxpayer is not married, files in February of 2025 for the tax year 2024, that can be as married filing jointly. And actually, this last one here is incorrect. It would be in 2025, he would then be, for that tax year, be filing as single. Okay, again, if married taxpayers divorce, they will need the court documents to prove that their separation for their filing status change. We generally don't need to see that. We just need to know that they do have it. And if taxpayers who are married filing joint do not live together at the end of 2023, the filing threshold is only $5. Again, it pays to file married filing joint. Okay, married filing separately qualifications. Okay, a married couple can choose to file each a separate return, which can be beneficial if it results in less tax owed. Now, for whatever reason, this past year we've had, I'd say, at least a half a dozen couples who were married wanted to explore the possibility of married filing separately. They'd always filed jointly in the past, but for whatever reason, they had it in their thoughts that they should go separately this year. Our software will allow us to do the analysis, but you have to be careful when you start it, and we'll kind of go through that once we start looking at the software. You need to assign all income sources to each, both the primary and the spouse. And there's many reasons why people may want to go married filing separately, and we'll get into that shortly. But here are the reasons why they probably don't want to go. And it is a higher tax rate than married filing joint. Excuse me. You're not allowed to get any credit for child or dependent care expenses, and the earned income tax credit. There's no higher education credits. That would be the American Opportunity, which is for college education for a bachelor's degree. Lifetime learning is for other education that you're taking for either improve your job skills or potentially getting a graduate degree. There's no exclusion for or credit for the adoption expenses. There's no student loan interest deduction, and there's no exclusion for interest income from qualified saving bonds used for higher education expenses. Also, if the taxpayer and spouse live together at any time in the year, automatically 85% of Social Security income is taxed, regardless of what their income is. And the filing threshold is $5. If one spouse used itemized deductions, then they both must. So again, in the red, this kind of sums it up in one sentence. Generally, the tax law encourages married couples to file a joint return. And the analysis that we did for the folks that asked for us to do it, in all instances, it was within, I believe, $10 of total refunds or total amounts owed that the difference between separately and joint is. Now, the reason many folks have over the years continued to file married filing separately is they may have come into the marriage with one party or the other, or both of them for that matter, having previous commitments that may impact their tax refund. Primarily child support issues, back taxes both to the state of New Jersey and the federal government, and even things such as motor vehicle expenses or fines that have not been paid. If all of that is on one spouse and there is a balance due to any of those authorities, the joint refund is subject to clawback until those expenses, those amounts owed are repaid. So by filing separately, then it's really, what's mine is mine and what's yours is yours. And some people just, that's the way even if there's not a balance due anywhere, that's the way they want to go. And again, if there's no children involved, a lot of times, and if they're earning the same amount of money and they're paying rent, generally there's no upside or downside for what they're doing. It's pretty much what they would have paid if they filed jointly. And that's generally what we see in the folks that we service with. I just had a woman call me just this week, and actually I'm meeting with her tomorrow to do an amended return because she has always filed married filing separate, and she has been claiming her elderly brother who is disabled. And for whatever reason, in 2021, she claimed as head of household. So my thought to her was, well, it sounds like you are head of household, but then she told me that she actually is still living with her husband. So again, you can't have a head of household situation where you have married filing separately as the dominant for both parties. Now, there may be, I asked her why they don't consider filing jointly. And she's like, I want to do my own thing. This is my thing. He does his thing. I do my thing. Some people are like that. Again, it is quite possible that there is no difference one way or the other. And I've had a few instances where the one spouse, they're non-filers. Maybe they work for cash. They don't want to file. They haven't filed in years. And so we do married separate because they are separate and they're sharing and they are living in the same address. Qualifying surviving spouse with dependent child. Okay, it's just kind of a unique situation. We only had one of these out of the 1,600 returns we did last year. So for the 2 years after a spouse has died, a surviving spouse with children can file using this status. And essentially, it allows them to file married filing jointly for the next 2 years. And I won't go through all the details of it because it happens so rare. But the reality is that, again, if there's a child involved, they'll get the higher standard deduction for 2 years. And then once it falls out of that, they'll become head of household. Okay, the impact on the tax return. Oh, there we go. Okay, again, filing status can impact the tax return in a number of different ways. Single, okay, again, it drives tax brackets and the standard deduction. For head of household, if you file as head of household, you get a different tax bracket and a higher standard deduction than the single filing status. It also offers a lower tax bracket at both the 10 and the 12% level. Jointly allows for both spouses to report their combined income and provides a standard deduction and tax bracket limit 2 times the amount of a single filer. Separately, each spouse can file separate, but that puts them in different and usually higher tax brackets than married filing jointly or filing single. Again, we went through this before. It disqualifies the taxpayer from several credits and immediately puts an 85%, subjects 85% of Social Security to income tax. Again, they cannot file single if they do not qualify as unmarried. Now, again, this gets into some situation where, although, if there's a head of household situation, because there's a child, we could ignore the fact that, they may be married, but they didn't live together. If they're married filing, if they're still married, but there's no children involved, and they want to file single, we have to have that conversation with them to make sure that they understand that, this may come back to bite them someday. Because again, frequently they haven't seen their spouse in years. They don't know his Social Security number. They don't know if he or she files, and they're just there to get their taxes done. We try and make do with the information the best we can, and understand that they have to understand that it'd probably be a good idea to get a divorce if they haven't seen each other in 5 years or more. Again, qualifying surviving spouse with dependent child uses this filing status, offers the married filing joint bracket and standard deduction for 2 additional years. Okay, so to recap, there are 5 statuses. Some taxpayers who file, who are the dependent of another taxpayer. Okay, that's a unique situation, and we won't go into that. That doesn't really come up with us. Again, they've got to indicate one of those statuses on the return. Filing status depends on marital status, dependents that can be claimed, and the taxpayer's living situation. Again, the filing status impacts a lot of the return. It drives the tax bracket, the standard deduction, and whether or not they can get certain credits. And now what we're going to put into the dependency part of this, which again doesn't affect single people because single people don't have any dependents. So again, you're going to understand who is considered a dependent and how filing status and dependents affect tax returns. So who is a dependent? A person other than a taxpayer or spouse who entitles the taxpayer to claim a dependency exemption as defined by the IRS. Okay, for 2023 and going back all the way to 2017, I believe, there has not been a deduction for dependent exemptions due to the higher standard deduction levels. But claiming a dependent can affect other tax issues such as status and some credits. So back in the day, you may remember that even the standard deduction was a whole lot lower, but you used to get like $4,000 or $5,000 per dependent that you claim. The way the math would work out is kind of the same, and it's a lot simpler now this way with the higher standard deduction. It clears up a lot of that ambiguity. Again, dependents must pass a number of different tests in order to qualify, and there's only 2 things that can qualify you as a dependent. You're either a qualifying child or a qualifying relative. So who qualifies as a dependent? Okay, there's 5 tests that must be met for a qualifying child. The first one is the relationship test. That means that it is your son, daughter, stepchild, foster child, or a descendant of those. So in other words, a grandchild of any of those, or your brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of one of those. So that would be a niece or nephew. Age, under the age of 19 at the end of the year and younger than you, that's if your spouse or your spouse if you're filing jointly. A student under age 24 and a full-time student for 5 months out of the year and younger than you, or permanently and totally disabled at any time during the year, regardless of age. Residency, okay, they must be a U.S. citizen, resident alien, U.S. national, or a resident of Canada and Mexico. They must have lived with you for more than half the year. That would exclude the parents, which we alluded to earlier. There are exceptions for temporary absences, children who were born or died during the year, kidnapped children, children of divorced or separated parents. Then there's the temporary absences. So your child is still considered to have lived with you if during the period of time when one of you or both are temporarily absent due to circumstances such as illness, education, which would be, the child is away at college, business vacation, military service, or believe it or not, detention in a juvenile facility. Okay, the support test. To meet this test, the child can't have provided more than half of their own support for the year. Again, that's usually fairly straightforward. It gets a little more complicated when you get into that age when they are out of high school and maybe they're not working. I mean, they are working, but maybe not so much to the point where they're supporting themselves. When they get above 24, then it gets a little trickier. A lot of folks get, kind of, it takes some convincing them that maybe their 22-year-old who's no longer in college, didn't finish or whatever, but is working full time and made $30,000 last year. Yet they still live at home, mom or dad, or mom and dad. They live there rent free. You feed them. Why can't I claim them? Well, at $30,000 a year, he could support himself. So you don't get to claim them anymore when those kind of numbers get involved. And the fifth point is a joint return. That the dependent can't file a joint return for the year. Okay, qualifying relative. So the first one is it's not a qualifying child. So a child isn't your qualifying relative if the child is your qualifying child or the qualifying child of any other taxpayer. So if the qualifying relative has qualifying child relationship or parent, grandparent, aunt, uncle, then they need to live in your household half the year. Any other relative or non-related person must live in the household the entire year. So again, member of the household or relationship, the person must either live with you all year as a member of your household or be related to you in one of the ways listed unto relatives that don't have to live with you. And that gets back to the Canada, Mexico thing with your parents. If at any time during the year the person was your spouse, that person can't be your qualifying relative. Again, that gets back to the whole idea of dependency exemptions and claiming one spouse. Again, all that's gone with the fact that, again, it's a higher standard deduction. You can't claim each other as primary and spouse. And the gross income test. Okay, a person's gross income for the year must be less than $4,400. And gross income, it is pretty straightforward. It's all income from the form of money, property, or services that isn't exempt from tax. So even though if your 28-year-old is living, is still living with you, and he made less than $4,400, you still get to claim him. And you'll get what's called the credit for other dependents. But again, that's only worth $500, and we'll get into that in 2 sessions from now. The support test. The taxpayer generally must provide more than half of a person's total support during the calendar year. However, if 2 or more persons provide support, no one person can provide more than half the person's total support. In a situation like this, there are instances where, particularly if this involves with divorce situation, I do have a small practice outside of VITA, and I have a client. They're both fairly high income individuals that they share joint custody of their one daughter, and they rotate every year between filing head of household and claiming the child. So every year it flips one way to the other. So again, the one the mother actually happens to have significantly more income than the father, but they clearly both would have enough to support the child, and that was part of their divorce decree that they get to flip that back and forth. Generally, those situations are we know that kind of going in. We've been dealing with folks over the years that, yes, I get to claim them this year. Or again, sometimes we have to extricate ourselves from situations where we really don't know who is claiming who. And that's, folks need to sort on that, because once you send in a tax return, someone's claiming someone, it's first one in gets to claim them. So I'm not going to go over this chart. This is from the 4012. It's a little I won't say it's misleading, but I find it a little hard to follow. This is part of the slide, but again, I think it gets back to kind of some of the stuff that we said. Most of our stuff is very cut and dry, and there are ways to sort through whether or not a person may be able to claim someone. Generally, it's more of a qualifying relative than a child. The child is their child, and if they're living with them and they're providing more than they have to support, that's pretty much all we need to know. So who is a dependent? Again, this is some more sort of back information, which I'm not going to go into, just kind of more of the same laid out in a different format. Now, the impact on the tax return. Okay, again, we're talking about dependents now. So you get the child tax credit is up to $2,000 per child up to the age of 17 for tax year 2023. Now that is, remember, up to 17. So that means if the child turns 17, they're not going to get the credit. So it's got to be 16 and under. The education credit, okay, that's up to $2,500. The American Opportunity Credit, and head of household filing status. Again, you get the higher standard deduction because you've got that the impact of that dependent that you're paying to support. So more of your income is going to be not subject to tax and at a lower rate. So to recap, again, we're talking that there are two types of dependents. There's the child test and the relative test. Again, there's the relationship, the age, the residency, support, and the fact that they're not on a joint return or filing a joint return. For the relative, again, they can't be a qualifying child, household membership or relationship test, gross income issues, and of course the support issue. Now, there are always random exceptions to this. And we can probably touch on those when we have an advanced topics session in January. I'd be happy to go over some of those with you, but for tonight, we're going to kind of wrap it up with that. But what I want to show you is based on what I'm going to try and do as we go through all of these slides is I'm going to bring up some of the material that we just reviewed, and then looking at the basic course. All right, the basic course, the first scenario, for instance, and this is very typical of what we see. So here's Tom. Tom is 36 years old and has never been married. Frank, age 13, is Tom's nephew, okay, who lived with him all year. Okay, Tom provided all his support and provided over half the cost of keeping up the home. He earned $44,000. Interesting enough, he's blind, but cannot be claimed as a dependent for anybody else. And they're both U.S. citizens and have Social Security. He's lived in the U.S. all year. So can somebody out there throw in the chat what they think the most advantageous filing status would be for Tom for 2020, 2022? No, somebody's there. Yes, head of household. Again, this is very typical of what we see. Again, this is from the 2022 test, but again, there's a question like this on the 2023 as well. But just to show you, again, this is what we'll be bringing this up in the advanced topics, and we just jump to one here in the advanced that is kind of fun to talk about because here we go. Let me find it. It can get a little more complicated. It generally doesn't. So here we go. Here's Alice Adams. Okay, Alice Adams is 58. She owns her own home. She provided all the cost of keeping up her home for the entire year. Her only income was $46,000. Okay, Linda, okay, is her daughter at age 24. And Linda's daughter, Nancy, so Alice's granddaughter, age 4, moved in with Alice after she separated from her spouse in April of 2020. So Linda's only income was $25,000 in wages. Linda provided over half of her own support. Nancy did not provide more than half of her own support. Obviously, she's 4 years old. So that's where it gets a little bit more interesting as far as who can, okay, we're talking a multi-generational family here where 2 people are working. Who can claim who? I would probably want to look at this from both who could claim whom. Generally, you go with the mother, but it may make sense to go with the grandmother. But again, these are kind of things that we kind of play around with from time to time when we get situations like this. This is a good one for discussion when we get together in person, hopefully, or when we have a little more interactive using the software to see how this might work out. But that's just kind of an interesting one that I find kind of fun to kick around every now and then. Again, we covered here in part 2 the marital status and household income, household information. What we're going to be doing in 2 weeks from now, so the Wednesday and Thursday after Thanksgiving week, is we're going to be reviewing the income situation here and the adjustments for income. So it's going to be part 3, the types of income that comes in, and also then the adjustments to income. So things like IRA deductions, educator expenses, a couple little odds and ends that we see. Generally, we don't see adjustments to income, but there are a couple that pop out, and we'll review those because some of them are on the test as well. So let me just, that's going to be it for what I really want to just get done with now. So I'm just going to hit the stop share and